Where's the YouTube link? In the chat. Okay. Pull this up here.
Okay, I think we're live. So thank you, everybody. Hello and welcome, everybody, to this very special event with XTB. My name is Walid Kudmani, market analyst for XTB, and I have the pleasure of having with me today Chris Laurie, very famous trader and entrepreneur, and a list of other accomplishments in his career and life. So to any of us, or to any of you who followed us in the Investing Day, which was a huge event we had just a few weeks ago, Chris was one of the speakers. He had an excellent presentation on gold and on a number of other really important factors about trading the markets and timeframes. And in that event, we had received a lot of questions from you guys, from all our clients, and from people that maybe were new to him or new to our work. And in this event, all we're here about is having a more one-to-one approach with you, the clients, or any potential customers that might be interested. And because of that, we have the pleasure of having Chris Laurie here with us to share his knowledge. So thank you very much for being here with us, Chris. Maybe introduce yourself for the people that don't know you, although I doubt there are many of them, but for them, just give them a brief overview of yourself and then we can move on.
Sure. Hi, everyone. My name's Chris, and I've been trading. I started out trading foreign exchange 21 years ago, and I've still continued to trade foreign exchange. I also trade S&P. I trade gold, and of course, now engaging in trading crypto, which I believe the entire financial landscape is going to change. And so it's good to get on that now and to get a real good understanding as to what's going on there. 2006, I was called to Singapore to speak about the fractal nature of the markets. And from there, I took on a client to manage their foreign exchange portfolio, and then ended up moving to Singapore 2011 and have since been working through the investment banks in Singapore and some trading through London as well.
That's very interesting because it shows that you also have some international experience. I think a lot of traders, perhaps they're locked into their markets, and you've had a wide exposure to a lot of traders and a lot of markets. So we have clients obviously from all over the world. And so to see somebody as well like yourself, who's well-traveled and has all these different approaches and different points of view can also help in their mindset as well. So without any further ado, I would like to move on to some questions that we received from people that watched that event with us or were at that event with us. And then if you have any questions that you're watching at the moment, please feel free to write them in the chat and we'll try to get to them by the end of this event. So we're definitely going to have a live Q&A session towards the end, but we're going to try and get to some questions that were asked at the event and since for Chris. So I'm going to start with I think one of the more simple ones we've received, because it's quite common to receive, is, let's see, in your experience, so a lot of the questions we receive are about the basics of trading or why you pick certain things. So in your experience, what time of day do you personally prefer trading and why, perhaps?
So it depends on which time zone I'm working from, because I'm sometimes working from Singapore time zone and sometimes from New York time zone. So if I'm working from Singapore time zone, I usually have a much longer day. Usually starts at the open of London. And so there's certain behaviors that I like to catch the open of London. There are sometimes specific price behaviors at the London lunch hour. And then of course, the close of London, I like to just simply trade that fade. But if I am in the New York time zone, I'm not getting up too early anymore. I used to do all-nighters for about 10 years, and but I don't do that. I don't do that anymore. So I'm usually just trading from about, it's usually pretty quiet from 6 a.m. New York time until about getting to around 7:30 or so, and then just depending on what's happening with gold, for example, then I'll look at, because there's very, very specific times of day that gold will move. And if it's setting up, then if I commit to a trade in that 7:30 a.m. to 8:30, 8:45 a.m. time frame, if it sets up and starts to move, then that's kind of where I'm focused for the day. And if I don't like what's happening, of course, I'm looking at the FX crosses to see what's going on there, and looking for setups there as well. So it's usually for the New York session, I'm not getting up too early. And now with the crypto markets, because they're a more passive trade, they're more kind of, long-term holds, but there's always things changing in the market. So that you can trade pretty well any time of day, but it does the pullbacks, it gets most active at the early New York, open to London, open New York. But so if I'm looking to get in positions, I've got my levels marked, and hopefully the volatility takes us to the downside, and that's usually New York. So I apologize for the lengthy answer, but my favorite time span of the day would be the early New York time span. And I think I should note that if you're trading foreign exchange, a big struggle is trying to figure out your life rhythm with the rhythm of the market. And there's not necessarily like an ideal time, and no matter where you live in the world, you've kind of got to figure out how you're going to blend your life rhythm with that of the rhythm of the market and when you're best available. So that's something that you've all got to kind of figure out that niche on your own. And so I'll have people do it in the form of understanding deeply the volatility that occurs in that area by going through a certain process to really connect with the volatility during that specific time horizon. And so you're not alone in trying to figure out how your life's going to work with trading hours.
Absolutely. And I think you touched on something excellent there, is that it has to be adapted to everybody's life in particular. But there are certain reasons and certain things that if you are trading a key market, you want to be maybe looking at those things that are affecting that market at a particular time. So maybe if that time doesn't suit you, maybe change market to a time that does suit you, in the sense that maybe USD might not suit you for Japan or something like that.
Yeah, and also you will, the more focused you are on a time of, let's say, a 2, 3, 4 hour time frame, what happens if you've really engaged in a good study of the price behavior during that time frame, you will find that you will connect very, very uniquely with the behaviors at that time frame, and you'll really find niche trades that work for you during that time frame. And gold is particularly distinct in when volatility increases and decreases. So it's a good one to study.
Absolutely. Okay, so for somebody else, moving into the next question, leading in pretty well. Then, I'm new to trading, this person says, but I'd like to learn how to trade gold. So to somebody who is new to trading and maybe the first market they want to pick is gold, do you have any tips or any sort of basics for them, for somebody who's new and looking to trade gold as a starter?
Yeah. So I guess I would want to know what time zone the person lives in, but there's very distinct volatility.
I would say London.
Okay. There's distinct volatility precisely at 0-100 hours. If you are kind of in the available that Asian session. And when you do get a bit of a volume spike, it usually then fades. There is a pretty distinct volume spike at 0-800 hours, but the time horizon that I like is anywhere from 12-30 hours, sometimes starts a little earlier, to about 14-30 hours. And if you get really good volume, if it's setting up, for example, recently gold has been quite bullish. So if we have retraced and we've hit a real distinct level of support, and there's many ways you can define support. There's quite a range of criteria, but if it finds support and starts to hint at upside movement, then you're probably going to see that movement to the upside, right? Barring any 8:30 a.m. data risk. So I think, and then if you're just learning to study gold, just start with simple support and resistance, simple support and resistance. And then it becomes more finite over time, but just start with support and resistance and watching the behaviors. And what you're going to find is that over a large sample size, if you're in, for example, recently we've been in this little uptrend for a short period, you're going to find that obviously support's going to hold more than resistance. So you're going to actually feel, internalize what happens at support and what happens at resistance. And you need to keep the two separate in terms of understanding the price responsiveness. And so it's a good basic, very, very basic way to kind of start, because gold trades most excellently in a very geometric, rhythmical pattern.
Thank you for that answer. I think that clarifies it a lot for people who think maybe they take it extreme. You know, they want to know everything about everything, many indicators, many time frames at the same time, many levels. But like you said, start focusing on the basics and then build on that. And I think we talked about this briefly. I remember asking you a similar question at the investing master or investing day, but I think it's quite a common question because yes, people do trade, for example, gold, but one of the questions we got was, does spot gold price movement correlate with any other financial instruments? So maybe they don't see a trade in gold. Is there anything else they can keep an eye on, or vice versa, in the sense that they're trading something? Could gold be affected, let's say?
Right. So if you are looking for correlations, it's important to understand that correlations will come in closer correlation and more distant correlation. So, for example, we have seen many, many phases of the US dollar and the equities, US equities markets. We've seen phases where they're in a very strong correlation and other times where there is zero correlation. So it's important to understand that, because they will come and go. And the same applies to gold. So gold can have a risk on, risk off, US dollar strong, US dollar weak correlation. But again, sometimes it's strong, sometimes it's weak, and sometimes it doesn't exist at all. And so as far as using it for what level of impact it has on my trading decisions is very little, fractional, because when you study price behaviors and price relationships and price flows, you will find that as over time it becomes so self-validating. The more you learn it, the more self-validating it becomes. And then so as a result, you'll find that if you have indicators on your charts or whatever other types of tools that are a part of your parameters for making your trading decisions, what you will find is that you will slowly start to peel them off. And so when it comes to correlations, you will find that you will place less, you'll allow correlations to have less of an influence on your trading decisions than more. But I'm not denying that there are sometimes strong correlations, but it's more an observation than it is saying, okay, this is telling me that this is a good trade idea at this point. I hope that makes sense.
It does, absolutely. No, it absolutely does, because like you said, price action, I think it's something that I'm learning to appreciate a lot more lately, because this quite a common question is, what's the indicator for this? What's the indicator for that?
Yes.
And I think a lot of people expect indicators to give them an answer or prediction, rather than maybe relying on their own analysis of the price action and then using the indicator for confirmation of some sort.
Very important point, if I may.
No, please do. Please do.
Traders, sorry, there's a lawnmower going in the back here. Hang on.
I can't hear it, actually.
Okay. When traders first enter into the trading space, they tend to have a heavy reliance on indicators, because they kind of want to, they don't have a lot of confidence. So they tend to want to gravitate towards something that will kind of make their decisions for them. So the mindset is like, well, whoever it was that invented this indicator must be smarter than I am, or must know how the markets work, or must know more than I do. So therefore, since I don't know a lot, I'm going to place my confidence in this, call it a system.
Yeah.
I'm not saying that mathematical models cannot work, but they will work if you created it. And let me because it raised a very important point in that you have to engage in a process of internalizing market behaviors, no matter how it is that you trade, whether you are designed to write code or oriented to mathematical models or price action or fundamentals, whatever it is that you connect with and find consistencies with, you're going to have to go through the process of seeing the correlation between your internalization of understanding the market and finding your niche and acting upon what it is that you've internalized and have found consistencies with. So ultimately, at the end of the day, the only way that you are going to become a long-term, consistently profitable trader is if you have found your niche, you understand that niche more than anyone else. You don't need anyone's validation because you've gone through the process of understanding this market behavior. So the process is, if this is you and this is market behavior, you've gone through a process of marrying your unique brain, okay? Not somebody else's brain, not trying to copy what somebody else's brain does. You can use people for resources, but you've got to marry your unique brain to understanding market behavior so that you can find your niche and ultimately become an independent thinker. And when you arrive at that point where you start making your own decisions and stop being influenced by people's trade calls and people's trading views that have knocked you out of many good trades, when you become an independent thinker, your trading is going to go through the roof. But you've got to build the foundation, and you've got to go through the process of building the foundation. Very, very important. Okay, so you know, I receive emails to my website saying, do you have trade call service? Well, I do share position trades that I'm in, but I am my unique brain, and I explain exactly why, because people are studying this material, but it's not a copy me trade system. And I say, that's not what you're looking. I don't have what you're looking for, because, and I don't know any copy me trade system that's ever worked over the long term. So please, you're going to learn it one way or another, but please engage in the process and commit yourself. You will not regret it. Absolutely.
And there are no shortcuts, I would say. So I think the what you mentioned touched on are basically the steps and shortcuts people try to take with trade signals, then maybe indicators that give them the idea, then maybe somebody who, an influencer or something like that. But it's like you said, it's very valuable to use this information that's all available in the internet and make the most and expand your own thinking. And Chris here is saying exactly the right thing. He isn't telling you to think exactly like him, but he's teaching you how to fish rather than giving you a fish. So in the sense of like, he is providing the thought process that you need in the sense to then apply these things and expand your knowledge and then make your own mind in the end. And so I think that's a common question we get. So thank you for addressing it in such a meaningful way to clarify everything. So I'll just move on to the next one. And let's say, what moves gold? That's a more basic question, but I think that's an interesting one maybe to hear your perspective on. What moves gold in the maybe fundamental sense, obviously, maybe not technical, but even technical, you might think that maybe perhaps certain levels are more important than others. So what's your take on it?
You know, it's a great question, and now brings accountability to my comments on correlations.
Exactly.
So I have to say that, you know, gold, like no other asset, gold covers the whole spectrum in terms of arguments as to why it should be selling off and as to why it should be rallying, or anything in between. The extent of arguments is really virtually endless. So there's a few things that are push gold is lack of confidence in government, lack of confidence in monetary policy, lack of confidence in currency, in the sense that, are we going digital? Are the governments going to come in and take all of our money away? And so those are a few things, as well as Yes, the sell-off in the equities market can contribute. Yes, a rally or a sell-off in the gold market, in the US dollar can contribute. So, and these things can change, and again, they can change in weight, right? So, so I think that's a very, very good point that you raised there. And I would say that those that I mentioned would be some of the thematic areas that you'd want to look at. And because if you look at the gold long-term chart, you'll see it does spend a very long periods of time in consolidation.
Yes.
So learning just to trade inside those ranges is a good idea if you're trading spot or futures.
As
Right?
swing
So,
trading, you would say some sort
yeah,
of.
yeah. So yeah, good question.
Thank you. So I just also like to remind whoever's watching us live at the moment that feel free to ask any questions you have for Chris, and we'll try to answer them as many as possible at the end of this event. We're just getting through a few questions that were received after the Investing Masters Investing Day we had just a few weeks ago with Chris, Lori, Chris Capri, and Kim Watson. So thank you to everybody who's watching at the moment. And of course, keep the questions coming. We're going to get to them by the end of this event. So I'll just move on to the next one, in fact. And going back to indicators, perhaps would you say you use a few, and if so, which moving averages should a person take advantage of? I think moving averages are some of the more basic ones that people can. Most people agree to have at least one moving average on the chart.
Yeah, it gets back to your unique way of thinking and what you connected and what you find consistency with, or good parameters or reference points. So I'm not against indicators at all. I'm not against you using, a full moon to trade. If you found consistency with it, then by all means, and you can think for yourself and not allow others to influence you, and you found patterns of behavior, then by all means do it. So I don't use any indicators. I do have on one of my templates, I've got this blue line, and it's been on my templates for a couple of decades now. And people always ask what it is. And to be honest with you, I don't even see it. But it's a 34 EMA, but I don't use it. So again, whatever it is, because I'm not an indicators guy, I don't use any at all, because you could put a ton of stuff on my chart, and all I'd be doing is I wouldn't see it. So I don't know if you watched a hockey game. When you're watching the hockey game, there's 3 referees on the ice, 2 or 3 referees. You don't even see them, right? So if you were to put this kind of thing on my charts, I wouldn't even see it. I'd be looking right through it. I know a lot of charts have tons of junk on it, and you can't even see the price behavior, but so that's just how I trade. And I'm not saying that's right or wrong for you. Okay. As long as you've gone through the process of establishing those parameters, then it can work. But I don't have any favorites in that sense.
I see.
But, I will say that it's maybe a good idea that if you find you have an affinity for putting some indicators on your chart, at least to experiment with and get a feel for, it's always good to have an experience and decide from the experience, rather than just saying, you don't want to say, Chris Laurie said no to indicators, because I'm not saying that. Okay. Put them on there, try it, but when you compare it to price behaviors that become self-validating, you tend to gravitate away from indicators.
Perfect. No, I completely agree. We going back to it. It is subjective, and maybe there are people who use a lot of them and that works for them. Maybe some of them find them as distractions, but give it a try, especially if you're a beginner. Don't rely on any one particular thing, and then give everything a try. At the end of the day, you have to make up your own mind. And so this is the best way to do it, is by trying yourself. A common question as well, this might be simple and maybe you don't have a specific answer, but I would put myself in the shoes of somebody who maybe is starting with very small capital. Is there a minimum you would say that they would have to start with? And if not, then maybe how do you think somebody with lower capital would be able to scale their investments or their trading portfolio?
So we have a process of building equity in a new account. So it's like, and I don't mean to use like a kind of a boring analogy, but because I come from Winter Olympic sport. I competed in 4 Olympic games, but it was in bobsledding. But I'll just use skiing as an example. Actually, I'll use skiing as an example because more people are familiar with it. So, you don't just show up one day and go to the top of an Olympic downhill and just rip it straight down the mountain. So to perfect your skill at skiing, you're going to do many different exercises in preparing your leg strength, your core strength, your body movements, your balance, the visual aspects. You're going to be training at different speeds, training on different types of terrain, mentally understanding the terrain, slowly moving faster and faster as you move higher up the mountain, taking on bigger challenges. You're going to start with the local races, and then you're going to build your profile in the local races, then the regional, then the national, then maybe you get on the World Cup B circuit, then the World Cup A circuit, then the Olympic Games. So it's a process, right? So the same thing applies to trading, and nobody, almost, because nobody, you don't ever use the words nobody, always, and never in trading, but
in life mostly, yes, exactly.
almost nobody wants to engage in the long, slow, enduring process of building equity in a new account. So obviously you start on a demo account. Everybody says, a demo account, some will say a demo account's great. Others will say it's useless because there's no emotional connection there to the interaction. But then when you get to a live account, in fact, I did about a 1-hour video on building equity in a new account. I think I did a 1-hour video. It's in my free members area on my website. So I think that it's a good one to refer to. But so getting down to the question, because I know that I'm talking a lot, just want to get to the specific question. What I would do is I would gain your first experience with putting a couple $1,000s in an account, trade the smallest sizes you can. But before doing so, you need to have already gone through the process of being very, very clear in what it is you plan on doing. And then it's not till you move to the live account that it's going to start shooting holes in your trade selections, right? So, and I'm trying to think of how I can shorten up what would be a very long.
No,
visual.
it's okay. I mean, I think it's an intimidating subject, so feel free to take your time. We have some time, and then I was looking to get some questions as well. So
the way we do it is we go through a process of, first of all, understanding the price behavior, single behavior, understanding price relationships. So one price parameter versus another price parameter, how they work together. It all has to do with liquidity pools, and the way price is delivered into the market generates a certain type of volatility. Okay, so we start by understanding these basic parameters, and then over time, you start to connect with consistencies that occur. Even though I already will show you, look for this specific price relationship and consistency, I can tell you all day long, you can't just go out and trade it live at first attempt. You need to first say, okay, let me understand price behavior A, price behavior B, put them together, and then where I would say these are the type of situations I like to make a trade. Then you practice it 20, 30, 40, 50, 60 times. Now it's becoming uniquely connected to your brain. So, because I can tell you one thing, but once you experience it and you connect it to your brain, then you say, now I've got to trade. So whenever the market does ABC, then this is when I'm looking to trade. So you start trading, now you take this to your live account. You take it to your live account with an inconsequential position size, and you have an experience. So now you've transitioned from the exploratory discovery phase where you've established very clear parameters. Now you take your clear and definitive parameters, and now you're going live with these parameters. Now, once you go live, it's now tapping into a part of the brain that you have not yet accessed because you have money at stake. So now you've got to train your brain how to manage this new dimension, this new stimuli. And so the only way to train it is to train it slowly. If you shock it with a big position, it's not going to know what to do. And then based on its confusion, you probably lose. And then once you've lost, what happens is you don't blame it on the brain's decision to put on a large position size. You blame it on all of the technical parameters instead, when it doesn't have anything to do with the technical parameters because you were on the right track, but the brain deviated from what it's supposed to do. And this is a critical point of reversal for people because they get brain damaged, but it's deceiving brain damage because they're just blaming on something that it doesn't need to be blamed on. So this is why you have to slowly access, and I did put this on one of the videos in the free members area. It's about you need to slowly take your brain to where it's never gone before, and you're creating systems. So what I have traders do is I have them, when we do what we call exercises, is the exercises are in order for them to internalize price behavior so that the price behavior eventually lives within them. Okay. And they're not only just going after the fact, looking at some price behavior, we're watching it live, but you're also watching it live, finger on the trigger, watching price, and you're creating this whole trigger brain observation connection so that you start to build a natural reaction to when you find price at an idyllic point to enter. You're automatically ready because you've trained that whole system. What we also do is we also train you, because most traders will see price move, they get excited and they pull the trigger. Usually that's the worst time to pull the trigger. And then often when fear is setting into the market and the price is moving in a way opposite to what they want it to move, they don't pull the trigger. But what we try to do is train you to identify when this is happening, pull the trigger, so that you're actually, at first you're pulling the trigger when your brain thinks you just should never be doing that. And slowly over time, after you see measured outcomes, you actually have retrained your brain how to actually want to see that price behavior. So for example, when price is selling off or pulling back into a very specific area with certain defining characteristics, when previously you would have been very scared, you've actually now trained your brain to be wanting and attracted to this type of behavior and pulling the trigger. But you've got to train yourself to do this first so that your brain actually knows what's going on and is very, very comfortable responding to this type of trading environment, right? And because anytime you go into a place where your brain has never gone before, the outcome is usually going to be just as confusing as to what your brain was going into the situation.
Absolutely. I think you touched again on one key issue that people face, and it's themselves as an enemy. It's like you're your own worst enemy, and you can increase that risk on yourself the more position size you have. Like you said, I think if you go into it all in at the beginning, it'll shock you, and especially if it's a bad, maybe if it's a good one, it gives you even worse, like false confidence, maybe. But if it's bad, then it gives you this idea that maybe something in the process was wrong. And it comes, I think, from, like you said, too much doubt, or the way you open a position is important. But I see a lot of traders, and I think something a lot of people make as a mistake is they open their position, the second they click it, they're confident, and then they see maybe they stay by the chart. So they'll keep looking at the chart after they open the trade and start to doubt themselves after they open the trade. And should I close it?
Because that's because the brain is only actually seeing one thing. Mm-hmm. Not till they pull the trigger do they see all of the vulnerabilities, right? And that's a whole other subject matter. But I wanted to point out the point that you made there is I've worked with, many traders and a good number of athletes as well. And you, not only are you your own worst enemy, that's fine. We hear that often. But the one thing that like athletes, a hurdle that athletes experience is that they don't recognize that after a certain level of experience, that they are their own greatest secret weapon. So traders will say, like, let's say I share with you some technical parameters, or you go onto my site and you look at some live trades and what have you. People will say, what are you holding back? What's your secret weapon? Well, your secret weapon is your experience. And you can take on an experience, but unless you've internalized it and understood it and broke it down, then the experience comes and goes. But with a lot of athletes and traders, is that athletes will get to a certain point where they have to recognize that they know themselves and how they are likely to respond to situations, how they best perform. They know themselves way better than a coach does. So it requires, like, the really, really good athletes that really make it to the top. It's going to require you to step away and really understand how to draw on your strengths. And because nobody knows it better than you do. Your coach doesn't know it better. You do. And you have to, and this is when you become a real independent thinker, and things really start to move in your favor. Because once again, as you start to move in that direction and crossing that line, then your performance becomes self-validating. And you basically, after a while, you'll probably even just shut everything else out. You won't want to be in a chat room. You won't go to forums looking for people's secret formulas. You won't, be looking for other people's trade calls or whether or not they think the pound's going up or down. You don't care about any of that, because I had this one Singapore-based client, and we would get on the phone with the FX desk, and the FX desk would say, this and that, and we think this can move, and we see orders flow with this one and that one. And after they went through this whole thing, she'd say, and I would agree, she'd be like, she'd do the complete opposite of what they said. And very, very, very successful. She was a developer, but she understood FX very well, and so it was just classic. And then after a while, the dealers would start calling us saying, "Look, I got all these clients. They want to get in, Aussie dollar or whatever," and we'd be like, "No, man, Aussie dollar's selling off." So anyhow,
tables have turned on that end. So
yeah, so we had all kinds of, I have so many stories, but
oh yeah, I'm sure. I mean, somebody with that much experience, like you said, I'm sure you've seen every kind of situation almost. So I'd like to actually do a quick, perhaps, or not even a quick, but if you'd like to maybe give your opinion, pull up a chart, what your thoughts are on gold at the moment, because I saw some like a bounce at the just recently. Maybe some supports, some resistances, what you see, and then we can move on to the live questions from people watching us at the moment. Again, thank you everybody who's watching. We've had quite a few people actually, and quite a few questions as well. So we're going to get to those as soon as we get through this technical analysis section. And then let's get to some live questions. So if you have any more, please feel free to ask them in the chat on YouTube, and I'll try to get to them as soon as we're done here before we finish this event.
So what am I doing here? Am I sharing my screen?
Yes, if you can share your screen, and then
we can do gold, or we can do any FX.
Well, you can do whatever. Well, yeah. I mean, basically, let's start with gold, and then maybe move on to some FX or.
Just a second. I've just got to move my.
No problem.
Yeah, I just need to hide that.
I'll just remind everybody as well who's watching us at the moment. So again, if you'd like to ask us any questions, please feel free to write them down in chat, and we'll try to get to them as soon as possible in this event. We're sure before we finish. So we've got through a lot, or at least a lot of the questions we received from the Investing Day event. So I'm actually kind of really looking forward to seeing as well what your take is on the charts today. So let me see. I can see your chart. Yes, I can see your chart.
Okay. So what you guys want to know, like a longer term view, or
let's do a perhaps a weekly or daily, and then maybe an hour, 4 hour. So either or on either. So to give people an idea of both time frames or aspects.
Okay, just let me. So I'm actually quite bullish on gold. What do I see a monthly there? I continue to be bullish on gold. Sorry, I'm just trying to fuss around with some of the windows here.
If you can, let me see. I'm trying to also.
All right. So
yes, perfect.
I think I'm going to take this down a little bit, but just before I do so, I think we've got because we are seeing some correlation with the U.S. dollar at the moment, and the U.S. dollar I think is going to make a little bit of a comeback, and so the gold I am bullish over the long term, but I think we can come back down to this. That's the start of the week, so let me just pull it down to the day here. And what I'm going to do is we're just going to look at a couple of features. So I mentioned this in the last webinar. If we're looking just at, call it support and resistance. So right now, what has occurred is you see this, what did I do with? So here we have this price swing. Right? Anytime price is rising, we're looking at, you see this point right here and this point right here. These are the points at which we generated a lot of volume in the move to the downside. Right? There, and here. So here are the swings. So we have this one. We've just come off of here. And you see how price came up to that level. Let's just walk through this. This area right here. So I'm going to take this. You have liquidity pooling here. So just think of this area as this area. I'm just going to show you what happens here. So as price rises into the area, there's a few things that I'm looking for. You see when price breaks through this area, so call that one this right here. So this one is this one. You see the nature of the price move, how thin it is. So you've got 1 day, 2 days, pretty skinny. The more price moves without accumulating, the weaker it gets. So it's getting weaker and weaker and weaker. Once it hits up into a liquidity pocket right here that I had noted, you see how it gets absorbed. So the bids are flowing underneath it, gets absorbed, continues to get absorbed, tries moving through again, gets absorbed. In the meantime, right here, you have a void in the bid. So you got a bit of a vacuum right here. And the next level of volume is probably going to be down in this area, depending upon what this looks like. So once price breaks through, so what you've got going on here is you've got a real increase in volume, and you've got an increase in kind of a battle between the buyers and sellers. And once that decision is made, if it moves to the downside, this level right here becomes more impactful. So you've got, this is a price swing right here. Usually if you've got accumulation, this is an apex. This is what's called an apex base. And this typically as an accumulation of liquidity. And that's what's happening here. And what I'm saying is that's what's happening right here. Right? So now price is drawing back, and you should get a tradable response right down in this area here. And I would do it more towards the bodies and where this started to move, right down in here. Let me just clean that up a little bit so you can see it. So right down in here. So when you've got a support, you've got the end of the wick, the tops of the bodies, the point that price, you see how you go into this lengthy consolidation, the point that price released from, the bodies and the wicks relative to this level. So when price draws back into this area, so you can see we collapsed, came back up, retested. Now, the reason why it's falling through this level is because there's a void of liquidity. So price can very easily come back and feed into this area right here. So I am quite bullish on gold for the long term, for talking multi-month scenario. Okay, so do not overlook that double bottom. Once price got through this area, signs of reversal. Once this area held, signs of reversal, and it gets through here. So back here, and I think we might actually go into consolidation for a while before it starts its next move. But you should see price respond at this level right down in here. Does that make sense? That's very simplistic layout. And so that's a fairly simplistic layout. And that's what I'm looking at for a longer term movement.
No, absolutely. And I think you clarified it in the patterns to expect or to look for sometimes. And they say, obviously, past performance is not equal, future. But at the same time, sometimes it can help. Like you said, you can see the upward move and then like a consolidation, and then upward move and a consolidation. I think something that's, like you said, a little bit more advanced that you touched on is the size of the wicks. What if it's a convincing move? If it's, like you said, it loses these things about losing strength as it goes on. And having to retrace. I think those are things that most people wouldn't even know.
So let me just take you down to a 1 minute chart.
Okay.
All right. So we just looked at a daily chart, and the microstructure and macrostructure of the market is a fractal nature. So in other words, patterns of self-similarity over a infinite spectrum of time. So I'm trading the same patterns for intraday trading as I am, and the same price behaviors as I am for long-term position trades. So if we just look at this simple 1 minute chart, I'm going to take a very obvious example here. If you look at, I want to just show you a couple of like quirky little features, because I know the last example was very basic. By the way, so the last XTB, what I did with the last XTB webinar was in the morning before the webinar, I recorded live trading, and I ended up recording the live trading, and I've got it available if you want to see it. And there is a live gold trading video on my website, but I wanted to record the live trading because afterwards, when I did the presentation for XTB, I wanted to show that I actually traded these movements. So, and that we were observing the movements in live time. So I want to show you a couple of quirky little things on a 1 minute chart that also exist on all time frames, because the time frame doesn't matter. It's a matter of scale. So you see here, when price moves into a low liquidity state, and the quieter price gets, the more vulnerable it is, because liquidity is drawing away from the market. So here you have a lot of liquidity coming in the market, coming in at market price. And the tighter it gets, the more barren liquidity is getting within proximity of price, right? Now, what happens is you get a volume shot. And if it's in an uptrend, the volume shots tend to be to the upside. You get a volume shot, and you see right here how we're in this very low liquidity state right here. Well, this is when we are most vulnerable to the next movement in price and shift in the entire, in all of the algorithms and the feeds quoting spot price. So once that shift occurs, I want you to notice this. Look at the size of the first candle, okay? Because liquidity is most rich, most dense, most voluminous within close proximity to price. You see how price makes a wider move? So now we are moving into a new state of liquidity, and each time price ticks, it's moving into a more inefficient environment of liquidity. So price has to move further to find sellers, to find counterparty offers. So price stalls here momentarily. Now look what happens when price breaks and makes a new high for the day. Now price is in even a more liquidity barren environment. You can see, look how far price has to move to find liquidity. You with me? Now, so price is moving a little bit, a little further, wider move within the same time frame. This tells you exactly what's happening with liquidity. And as a result of the function in the higher volatile movement in price, you get volume spikes, okay? The volume spike actually started at the base, but didn't move a lot because there was a lot of volume present in that area. Then as price moved on, it had to find counterparty. So you typically get these behaviors, and they're quite consistent. Now follow me on this. As price is rising, it's getting weaker and weaker and weaker, moving into thinner and thinner environments of liquidity. So when is it going to stop? Two things. You have a combination of two things. This becomes a vacuum, and it runs dry on buyers. And you look for a point at which there's pooling of liquidity, the presence of liquidity. When you combine those two things, price will draw back down that vacuum. So I've got a question for you. You see this bearish movement right here? Is that because a bunch of sellers came into the market? Right?
It was, can I answer?
Yeah.
Or can I give an opinion? Is it because perhaps there is nobody to buy at that price?
Right. So it is a vacuum or an absence of buyers, right? Is what it is, right? So that's right. So you can see here that the volume actually drops off, and price is drawing back, looking for liquidity. And where does it find it? Right here at the body. I'm always looking to see if it hit the body or the wick, because there's some differences there, and it makes a difference in your decisions, depending on the size of the wicks and so forth. Now watch what happens. You see how price created this reversal point? Now, can you remember all the way back when I talked about the daily chart?
Yeah.
About the shift? There's a difference between an accumulation and a continuation, and an accumulation and a shift. So now watch what happens. As price gets bid up here, as price rises back up this weak leg, so now it's doing the exact same thing on the way down. What's it looking for? There you go, right there, exactly on that spot. These rhythms happen all day long, all day. Price moves from one point of liquidity to the next, to the next, to the next. Now, obviously, you have to aggregate your understanding of many different micro facets of price behavior and liquidity pooling and volatility. You combine them together to ultimately make your most finite trading decisions. But this is what's happening all day long. So price comes up, hits liquidity, weakens, stalls there. Now this is the you see this little pocket. It's what we call a breakout tag. When it comes back in, it goes then to what we refer to as a liquidity base, and responds, goes up to where? The last point of liquidity. So it goes from one point of liquidity to the next, okay? Now to this base right here, back, and then to the next, okay? So it just, all day long, it just create trading in these rhythms. And so this is just a 1 minute chart. So you can scale it to a 5, a 10, a 22.5 minute chart, you know, 34-minute chart. Price is price, because it's a fractal nature.
Yeah.
So I'm using the same, the same behaviors. I mean, this is just a very small sample, but that's basically what we're looking at. So I just showed you consistencies in price behaviors on a 1 minute all the way to a daily, and then you have everything in between.
Yeah.
And nothing, and this basically nothing changes, right? But your tempo has to change, because if you think the daily chart's going to move like your 1 minute chart's going to move, it's not. And if you think your 1 minute chart's going to give you a 40 pip response, like your daily chart might, it's not.
It's not going to happen in that end.
So it's this, then the scalability is a factor in terms of what type of trading time horizon and framework you're looking at. So there's just a couple of little examples, but we get into this into very, very fine detail.
No, I'm very happy with the answer, because it is very interesting to see that, as somebody who also looks at charts all the time, that you start to see the same things happen over and over again. And sometimes it's unexplainable, sometimes it is, but at the end of the day, you notice these patterns, and you can't predict what's going to happen, but it starts to become a possibility of a few things that could happen. Let's say if you see a consolidation, there are certain possibilities, and then based on the assessment you made in the moment, perhaps you would then enter the trade or not enter the trade, or take it long or short. So giving us this experience of on the 1 minute to the 1 day really helps, because again, touching on the question we talked about at the beginning, what time frame should you trade on? This shows you that whatever one you pick, you can roughly apply the same principles, just set your expectations according to that. And then based on that, you can then learn the correct approach. And so,
and everybody has a different temperament, so, and the reason why you need to go through the process of engaging is to figure out what model is going to work for your temperament. And there's a video in my free members area on trade frequency and trade frequency and the probability continuum, because people will just say, oh, I'm a scalper, and they'll go out and they'll make 20 trades in a day. Well, that there's you're diluting probability. The more trades you make, the more you're diluting probability. So it's important to understand, some of the simple math behind what you think about yourself. You have to go through the process of figuring out what ideally works for you.
And can I ask you then the follow up to that of what would be, for example, so if 20 is too much, let's say, how many would a good day be for somebody who's maybe has a job, let's say, and they don't want to open 20 trades a day? I think that, like you said, focusing on getting it right is the key thing.
So to answer your question, there's a few things. Is that if I'm looking at, let's say, if I see prospective 10 trades that I think can work for me, I'm probably taking 3 of them. And of those 7 that I don't take, do you think a lot of them go in the direction and do exactly what I thought they would? Of course they do.
Probably, yeah. I was going to
say
say
that.
They
do. All the time.
Do you regret it, or do you not?
Happens every day. So this is the part of trading you need to resolve with your brain, that's just a part of trading. It's not a distinguishing feature that tells you whether you're good or bad, right or wrong, should have done this, should have done that. You have to accept that passing trades and missing good ones is a part of trading. It doesn't mean that you're a bad trader because you let 5 trades go by that you should have taken or you thought could work. But it doesn't matter. And the other thing you can do is you can do exercises around the one that you don't want to take live, or you can also scale way down on your position size. So you can literally scale it from passing it by and never looking at it again to demo to small size. But missing trades that go to the moon are a part of trading, and you'll never escape it. So don't think in your brain that you have to get every trade that moves. Also, don't try to pick the bottom and get out at the top, because for every 20 times you try it, it'll work once, and that one experience will cause you to make 20 more attempts. Okay, so if you're kind of like dabbling in that mindset, you have to be more open to be just prudent, take money out when the market gives it to you, manage your positions prudently. There's nothing wrong with breaking even at a trade. If you have a sample size of 50 and 20 of them are break evens, there's nothing wrong with that at all. Doesn't mean you're bad. It means you're prudent. But over time, these things tend to refine themselves, because with every experience, you're internalizing more, and you're moving one more step away from breaking even to getting from 20 break evens to 15. But also, the market environment changes, right? So this is why I love price behavior, because you can tell right away all of the different changes in the macro environment as well as the intraday movements. So you know that if you go through a long phase of break evens, it's because the market environment is not working as it would when you're taking fewer sample size of break evens, as an example.
Well, thank you very much for that. I'd like to then move to some live questions, so I don't want to take up too much of your time. Obviously, we do appreciate you being here with us to answer all these questions. And so let's see. Let's start with some questions from the chat. I saw the first one we got was from Ailanda Sulkas, who said, would you say it is worthwhile trading Forex medium to long term, or is it better to day trade? Would you classify Forex as low volatility for midterm to long term currently?
I'm sorry, I was just distracted there because I wasn't sure if I was on screen share or not. So
yeah, you're still screen sharing. Yes. I think, yes, you are still screen sharing. But the question is basically, would you say it is worthwhile trading Forex medium to long term, or is it better to day trade? Would you classify Forex as low volatility for midterm to long term currently?
So currently,
it's very generic, but
yeah, currently volatility is quite low in comparison to the early 2000s, and there's two main reasons. One reason is the contraction in the yield spreads, because foreign exchange trends based on yields, yield factor. And the other is with the improvements in some of the high frequency algorithmic trading. It's neither good nor bad for the markets. In fact, it's slightly good, because it is actually made, it depends on how you trade. So based on the way that I trade, it's actually made the markets and price movements really more efficient in a lot of ways, and more consistent and a little bit more finite in a sense. So we don't see as much spiky behavior as we did in the early 2000s. So it's been good in that sense, but volatility has dropped off. But what I recommend, I mean, okay, again, it's all relative, because I can be talking to a room full of completely different types of traders, right? Because everybody's unique. But when you're studying price behavior, what I like to do is have people study price behavior, typically on the smaller time frame. So let's say 60-minute down to 1 minute, because you want to engage intensively in understanding individual behaviors, price relationships, market structure, because it's just more intensified, and you get more, you can take in more information over a shorter period of time. So if you've only got 2 hours to spend in front of your computer, you can sit, you can study volatility, and you can engage for a couple of hours and maybe get in, 3, 5, 10 sample incidents. So, so I recommend that. And then what will happen to you is, to answer the question, what will happen is that you will find that you tend to appreciate the tempo and the application of the tools on a certain time frame. So maybe trading a daily chart, but picking your levels off of a 60 or 30-minute chart, and then holding for multi-day periods or multi-week periods, but your trades are obviously going to be much more infrequent, right? Whereas if you're trading intraday, then for me, trading intraday, I'm looking at levels on all time frames, but mostly the 30 to 60. But once I know my level, I am pulling up my 5-minute, 1-minute chart. I'm watching the micro behavior to make my ultimate decision to take on the trade and set up the initial parameters. Okay, so so it becomes very individualistic, but what's important is that when you engage in the process, you're going to find that based on your temperament, you prefer a certain type of trading. But I do recommend studying and acquiring and internalizing market behavior on the smaller time frames, and then scaling back. Because once you got it on the small time frames, then it's easily adapted to the higher time frames.
Well, I think people forget sometimes that the higher time frames are made up of the smaller time frames. So, a 1 hour candle is 61 minute candles. So
it's all human beings.
Absolutely. So we got another question. Hi, Chris. So Stratton Oakmount says, hi, Chris. I love trading gold and have been into technical analysis for 7 years trading. In the process of adding crypto to my education, can you recommend a good background book on gold trading? Do you have any recommendations for gold or any trading books in particular, perhaps, that may have helped you?
This is where I'm a bit rogue. Again, I don't discourage any books. I find books just don't tend not to get into the level of detail that you need to. You might be able to pull out a couple of nuggets for consideration to explore within yourself. When I started trading, I only went through a few books, and I just didn't find there was a lot in there for me, and I would just spend my time on the charts. There was one book that what happened was Wiley approached me to write a book, and I figured, well, if I write a book, it would be on psychology because it's be more timeless. So they gave me a whole bunch of trading books, and I was looking at a few of them, and this one book was interviews with traders. And I thought, okay, that's because I like to understand how people think, because everybody is just so different. And so I started reading some of these individual experiences, and I want to do a podcast on this subject. And there's a very, very important, consistent theme among all the traders, and that is they are all their own unique mind, and they all had a stop, like a stop limit, like it's when you take a certain percentage loss in a day. So if you're trading short term, for example, and for example, my rules are if I've taken more than 0.5% cumulative losses in a day, then that's it, the trading's done. Or if you trade X number of successive losses in a period, then you cut off trading, because you have to reset, because as you take losses based on different size, either in size or in number, then these toxins start to interfere with your thought processes. And you need to have a strategy to dissolve the toxins and come back to neutral so that you can see the market clearly. Because as you accumulate losses, your brain starts to make decisions that are not in your best interest, and it becomes even more damaging. So every single one of these traders had loss limits, and they all knew based on how they traded, they all knew very clearly when they were going to stop. And and held to that discipline. So, because I can tell you for certain that if your account draws down by 2%, doesn't seem like a lot. People draw down by, like retail traders will draw down by 7% in a day. But when your account draws down by 2%, your brain is already changing considerably. And then it just starts to cascade from there. The idea behind loss limits is you're just protecting your brain. You're not protecting your account, you're protecting your brain, which will protect your account. Okay. Very interesting, very, very important strategy to employ.
I'm very interested in that. And I share your interest as well for the psychology nature of this. So I find it very interesting and helps me as well find out why I do the things I do sometimes, or why you think about pulling out of trade when maybe you thought it was right, or all these ideas. The Random Explorer asks, do you look at order flow in trading?
Are we back on visual? Okay. Well, I look at order flow based on what I'm seeing on my chart. So it depends on what you mean by order flow, because there's many interpretations of it. There are, there are various algorithms that can give you an indication of certain types of order flow. Order flow can be represented sheerly on volumes coming through a specific source, or the order flow can be represented based on new price changes, or contracts traded but not actually reflecting on the size. So there are different interpretations of it. But at the end of the day, we have done studies on this and the parallels between the various interpretations or representations of order flow and volume. And we found that there's a pretty strong correlation, so that it doesn't matter too much which one you decide to connect with. But I'm typically just watching it on the chart, but I'm looking to see where there are micro gaps, inefficiencies, larger distribution of volume based on the movement of the recent prices. So I'm looking very closely at that. But as far as like pulling up a ticket and watching, level 2 depth, no, I mean, I'm not really doing that, because it's just too visually, just too much going on there. And you can see it in the price behavior anyway.
Exactly. Yeah, I was going to say that. And you said that you use it in a way that is in addition to everything else that you do, but you wouldn't make it.
You can see it in the price behavior once you study price. So I'm watching it in the price behavior.
Exactly. Well, thank you for the question, of course. And then one last question before I have one of my own, if I may, as you mentioned crypto as well. But let's ask this final question from a viewer who says, Zion says, I listened to your podcast with Trading Nut. You mentioned a big part of your development came from researching specific price behaviors. What exactly would you look for, and what would you advise to somebody who, I guess, was maybe not as familiar? We touched on this a little bit earlier, but just to briefly touch on this question. So that
I would say that just some of the little points. So some of the little points that I made visually earlier as well. If you go to my website and just look at some of the videos in the free members area, it's pretty basic, but the feedback that I get is that it's a lot more than they've ever seen elsewhere. There have been a good number of other like educators that have come in and copied it and then gone off and run programs or whatever. But just go there and have a look and see. What I tell people is just because I respect that everybody is different, and so what I just say to people is go in there, see if you connect with the content, if that kind of works with you. If you find value in it, then just watch more. And then there's always a subscription option, but I mean, actually, the monthly, there's like 200 plus videos in there, and it's only $99. But anyway, everyone's.
Yeah, I was actually going to ask you at the end.
We just try to provide them with information to help them make good decisions for the direction that they're going.
Absolutely. And that's all you can do at the end of the day. You're not trying to take the decision for them, but you're trying to teach them how to take that decision for themselves. And in the long run, I think that's way more useful. So please, anybody, if you'd like to mention also where people can check you out, your content, your website name, maybe if you have any sort of social media, It's always a pleasure, obviously, having you on these events with us. And I'd like to thank you once again for being here with us today to answer these questions and share your knowledge with all of us, including myself. I really do appreciate it.
Pleasure.
One last question for me, actually, before we end it. My question is, so obviously crypto seems to be becoming a bigger and bigger topic of discussion. More people, retail investors are shifting to that. More institutional investors are shifting to that. A lot of them are making it part of their investments. Do you think it's going to take some attention away from gold and that aspect of maybe the safe haven or the inflation counter? Or do you think gold is just going to be staying as it's because it's the physical market that it's that, and then crypto is crypto?
You know, because the gold people are like old people like me.
Yeah. Well, that's it.
And the those who have an affinity for crypto are the younger generation, and so it's going to be interesting to see. I think that gold will continue to maintain respective value for long-term hard asset, because gold is a completely different asset than a cyber asset or digital currency. And I think there's value in that. And I think that will continue to hold. The thing about the cryptocurrency space is that the world doesn't know what's going to hit them, because you're looking at, for those of you, I'm not sure if you guys were around for the tech bubble. I think this is going to be tech bubble on steroids, because when the tech bubble started, we only had, when the tech bubble started, the internet had just come online. People were just getting more of an affinity for computers, trading through brokerage accounts, things like that. It was pretty new. And the US equities markets was limited to a certain number of people. And so now you have the entire financial landscape is going to change. It's going to go, blockchain, digital coins. And now it's already, of course, spread into various sectors on the blockchain. And basically anybody who's got a mobile phone is now in the blockchain market. And whereas some people who couldn't even open bank accounts before, couldn't open brokerage accounts, now they're in the market. And the utilization of the new technology is going to be widespread and a part of our everyday lives. And I think this thing is going to completely explode. And it's just going to be massive. So if you think of the number of people that were in the NASDAQ bubble, call it 100 million, this is going to be 6 billion people moving into this space. And the slowest ones to respond are governments and institutions, right? So you're going to see the government's going to create a lot of volatility, because one day they'll say, if you own Bitcoin and we find it in your account, we're going to tax you for it and you might go to jail. And then Bitcoin will sell off, everybody will run out of Bitcoin for a few days. And then 2 days later, they'll say, oh, we didn't say you were going to jail. We said it was going to hail. Okay. And then Bitcoin rallies, and goes back. So, you're going to see a lot of this. And I don't mean like just Bitcoin. Bitcoin is
yeah, it applies to the, I completely agree.
But all of these assets, because technology is coming at it from such a wide range of angles to try to figure out how, smart contracts, for example, smart contracts on the blockchain, and where they're going to fit, if they can work, if they can manage the downside risks of, accommodating a smart contract on the blockchain, things like that. So there's going to be, a lot going on there. A lot of these will go to zero, and a lot of them will go to the moon. So it's a good idea to get in there and start learning.
Absolutely. So thank you again for that and everything else, and for sharing your time and your wisdom with us today. I would like to also thank everybody who was here with us today watching, and whoever may watch this on demand later on. Thank you for submitting your questions today and through the events. And again, we look forward to having you on anything really, on more events, Chris. I'm always interested to hearing what you have to say about these topics. So thank you again, Good
Thank
luck with
you.
your trading and have a good evening.
Great. Thanks. Thanks, folks.